Did you know your Social Security check could be much smaller than what's on your statement? Stick with me to uncover 4 sneaky reductions that might surprise you, and how to plan smarter to keep more of your hard-earned benefits. If you're nearing retirement or already there, you've probably glanced at your Social Security statement and thought, "Great, that's what I'll get each month." But here's the catch. That number might not be what actually lands in your bank account. Why? Because 4 hidden reductions could take a big bite out of your benefits. These aren't errors on your statement. They're part of how the system works. Today I'm breaking down these reductions in a way that's easy to understand, like we're chatting over coffee. We'll cover how your claiming age, taxes, Medicare costs, and even where you live can shrink your check. Plus, I'll share practical tips to help you plan ahead. Ready to dive in? Let's make sure you're not caught off guard. Number 1. Timing your claim can make or break your benefits. First up, when you choose to start Social Security can have a massive impact, potentially costing you hundreds of thousands over your retirement. Let's say you're 62 and thinking, why not take Social Security now? It's better than nothing. But here's the deal. Claiming before your full retirement age, usually 66 or 67, depending on your birth year, permanently reduces your monthly benefit. For example, a couple with a solid nest egg, say $2 million in savings and a paid-off home, decided to claim early. The husband's benefit dropped by $800 a month for life. Over 20 years, that's nearly $200,000 lost. Are you wondering if you should wait? For many healthy folks, delaying until 70 can boost your benefit by 8% each year after your full retirement age. That's like a guaranteed raise you won't find elsewhere. But let's dig a bit deeper. Why do so many people claim early? Often it's fear. Fear that Social Security might run dry or that they need cash now. The truth is, Social Security is designed to be there for you, and for most couples, waiting can mean a bigger, more secure check later. If you're healthy and have some savings to bridge the gap, delaying could be a game changer. For example, if your full retirement age benefit is $2,000 a month, waiting until 70 could bump it to $2,640, a 32% increase. To make this work, start by visiting ssa.gov to find your full retirement age. Then, take a hard look at your savings and health. Can you afford to wait? If you're married, consider your spouse's benefits too, as your choice could affect survivor benefits down the road. Planning early gives you clarity and confidence. Stay with me, because the next tip could save you from a tax surprise. Number 2. Federal taxes can take a chunk of your benefits. Here's a shocker. Your Social Security benefits might not be tax-free. Surprised? Many seniors are. The IRS looks at your provisional income. That's your total income from things like retirement accounts, pensions, investments, and even half your Social Security benefit. If that total crosses certain thresholds, $32,000 for couples filing jointly in 2025, for example, up to 85% of your benefits could be taxed like regular income. For our example couple, pulling money from their retirement accounts pushed them over the limit, costing them thousands in extra taxes each year. So, how can you soften this blow? It's all about planning your income sources wisely. For instance, withdrawals from a Roth IRA don't count toward provisional income, unlike traditional IRA or 401k withdrawals. If you're in your early 60s, you might consider converting some traditional IRA funds to a Roth IRA before you start Social Security. This could lower your taxable income later. Another strategy? Spread out your withdrawals over several years to stay under the tax threshold. For example, instead of taking a big lump sum from your 401k, take smaller amounts annually. You can find the latest provisional income thresholds on irs.gov. Bookmark it for easy reference. Curious about the next hit to your check? Let's talk Medicare costs. Number 3. Higher income means higher Medicare costs. Ever feel like you're being penalized for saving well? This next one might sting. If your income is above certain levels, around $103,000 for couples filing jointly in 2025, you'll pay extra Medicare premiums called Income-Related Monthly Adjustment Amounts, or IRMAA. These extra costs come straight out of your Social Security check, shrinking what you take home. Our example couple didn't budget for this and faced thousands more in annual healthcare costs. Here's how it works. IRMAA is based on your income from 2 years prior, so your 2023 income affects your 2025 premiums. If you're a high earner, you could pay hundreds more per month for Medicare Part B and Part D. For instance, a couple earning $150,000 might see an extra $2,000 to $3,000 in premiums annually. To avoid sticker shock, estimate your retirement income early. If you expect a big income year, say from selling a business, plan to lower your taxable income in later years. You might also appeal IRMAA if your income drops due to retirement or another life event. Check Medicare.gov for the latest IRMAA thresholds and appeal process. Stick with me, because the next tip is a real eye-opener. Number 4. State taxes could catch you off guard. Here's the one that even trips up the pros: state taxes on Social Security. You might think moving to a tax-friendly state saves you money, but some states still tax your benefits. Take Colorado, for example. It's got no broad income tax for many retirees, but it can still tax Social Security for some, adding hundreds or thousands to your tax bill. About a dozen states tax benefits, and the rules are tricky. Some states with no income tax, like Tennessee, might still target retirement benefits, while others with income taxes, like New York, exempt Social Security entirely. Let's break it down. If you're eyeing a move to a warmer state, don't just assume it's tax-friendly. Research the state's rules on ssa.gov or its revenue website. For example, in Colorado, if your income exceeds certain limits, you might owe taxes on your benefits. In contrast, states like Florida and Texas don't tax Social Security at all. Before you relocate, calculate how state taxes could affect your budget. For our example couple, moving to Colorado cost them an extra $1,000 a year in unexpected taxes. A little homework now can save you big later. There you have it, friends. 4 ways your Social Security check might be smaller than expected: timing your claim, federal taxes, Medicare premiums, and state taxes. Your Social Security statement is a starting point, but your real take-home depends on your income, where you live, and when you claim. The good news? With a little planning, you can keep more of what you've earned and enjoy the retirement you deserve. Have you checked your statement lately? Drop a comment below and let me know what surprised you about these reductions. For more tips to make your retirement rock, hit that subscribe button and tap the bell so you don't miss our next video. Thanks for joining me today. Here's to a worry-free retirement.